FinTech today is often seen as a uniquely recent marriage of financial services and information technology. However, the interlinkage of finance and technology has a long history. In fact, financial and technological developments have long been intertwined and mutually reinforcing. Just a proof that fintech existed prior to becoming a buzzword in 2014, we have the famous British economist John Maynard Keynes saying, "The inhabitant of London could order by telephone, sipping his morning tea in bed, the various products of the whole earth in such quantity as he might see fit, and reasonably expect their early delivery upon his doorstep. He could, at the same moment and by the same means, adventure his wealth in the natural resources and new enterprises of any quarter of the world and share, without exertion or even trouble." I could actually identify three kinds of fintech companies or fintech products and services in this quote alone, which Mr. Keynes said in the 1920s. Fintech means different things to different people. And the aim of this lecture is to provide a working knowledge of fintech so that during public discourse regarding fintech, we are more or less hopefully referring to the same thing. We will quickly cover these three main points: an overview of fintech, the current AML CFT risks, and the current regulatory environment. So let's dive in with the definition of fintech. The origin of the term fintech can be traced to the early 1990s and actually referred to the Financial Services Technology Consortium, a project initiated by Citigroup to facilitate technological cooperation efforts. Fintech, a combination and contraction of the words finance and technology, is a term that applies to any emerging technology that helps consumers or financial institutions deliver financial services in newer, faster ways than what was traditionally available. It broadly refers to technological innovations applied to finance sector. Did you know that fintech as a term or word has gained entry to major dictionaries over the last few years? Although no single definition exists. One of the most accepted definition is the one provided by the Financial Stability Board or FSB, which is an international body that monitors and makes recommendation about the global financial system. FSB defines fintech as being technology-enabled innovation in financial services that could result in new business models, applications, processes, or products with an associated material effect on financial markets and institutions and the provisions of financial services. Let's discuss the evolution of fintech. So the introduction of telegraph in 1838 and the laying of the first successful transatlantic cable in 1866 by the Atlantic Telegraph Company provided the fundamental infrastructure for the first major period of financial globalization in the late 19th century. Prior to the transatlantic cable, communication between North America and Europe was delivered by ship and took 10 days. The cable reduced it to 17 hours. It also facilitated the development of the global telex. In the 1950s, we also saw the predecessor of the modern-day credit card being offered by the Diners Club. We consider this era as FinTech 1.0. FinTech 2.0 is the switch from analog to digital. This brought us the first ATM machine by Barclays in 1967, which marks the beginning of modern FinTech. The digitalization of finances increased due to the development of digital technology for communication and transaction. It was also the era where the world was introduced to NASDAQ, its first digital stock exchange, and SWIFT, marking the beginning of financial markets and communication protocols being used today. The 1990s saw the first movements towards digital banking, with customers starting to manage their money in different ways. And we saw a visible shift in how people interact with financial institutions. The global financial crisis in 2008 is the year we entered FinTech 3.0. Due to the financial crisis, people started distrusting traditional banking services and fresh players started emerging. New startups began popping up with known and established technology companies began delivering financial products and services to business. 2009 was also the year the world was introduced to Bitcoin, followed by other different cryptocurrencies. Smartphones have become the primary means by which people access the web and therefore different financial services. Some part of the world have entered FinTech 3.5 due to the developments in their FinTech industry. The underlying technology that's driving FinTech 3.5, namely blockchain and open finance, will continue to drive the FinTech innovation of the future. FinTech itself is a sector of the broader tech industry. The tech industry is a massive umbrella term for a whole bunch of technology sectors and companies. FinTech is also not confined to specific sectors or business models, but covers the entire scope of services and products traditionally provided by the financial service industry. Based on use cases, the most prominent ones are the ones that you're seeing on the screen. Note that you can see online banking as one of the FinTech use cases. Some would opine that banks or other traditional financial intermediaries are excluded or should be excluded from FinTech. To that, Yang Kai-shing, CEO of the Industrial and Commercial Bank of China, which is the largest bank in the world by market share and asset size for some time, has been quoted in saying that there is a perception that when banks develop internet technology, it is not regarded as FinTech. So going back to the general definition of FinTech companies, which are firms that use technology-based system either to provide innovative and cheaper financial services directly, we can totally agree with his statement. So clearly, traditional financial services are a central aspect of FinTech. For this lecture, we shall only look at payments, which broadly covers remittance, mobile wallets, or payments in general. Just some important terms. First, payment is defined as a transfer of an item or value from one entity or person to another in exchange for provisions of goods or services or to fulfill a legal obligation. While payment transaction is an act initiated by the payer or on his behalf or by the payee. It's an act of placing, transferring, or withdrawing funds, irrespective of any underlying obligations between the payer and the payee. Lastly, payment system is the tools for payment of services or goods carried out in the internet. Payment system provides the ease of transaction processing in e-commerce between consumers and sellers. I guess we have been using the payments. We've been using payment system for some time, like the classic payment transaction I'm showing on the screen. And we may fail to appreciate at times the FinTech processes happening behind the scene. Let me now turn your attention to the current regulatory regime for FinTech. This is my thesis of what the current payment regulatory ecosystem of the Philippines look like. We do follow an entity-based regulations, which means that the specific licenses of the entities determine the regulators and regulation that apply to them. Under Republic Act number 1127 issued in 2018 or the National Payment Systems Act, the Bangko Sentral ng Pilipinas or BSP has been tasked to oversee the Philippine payment system and to ensure the stability and effectiveness of the monetary and financial system. The biggest player or the biggest pie in this diagram are the operators of payment system or the OPS. This is followed by covered persons, which under the Anti-Money Laundering Act of the Philippines are financial institutions and designated non-financial businesses and professions. Covered persons are mandated to comply with anti-money laundering and counterterrorism financing laws and regulation. As you can see, not all OPS are covered persons, which means that there are payment systems who are not legally mandated to comply with the requirements of the anti-money laundering laws and other relevant laws. requirements such as the full suite of customer due diligence, reporting requirement, among other things. Let's go to remittance and transfer company. It's the gray circle marked as C, which refers to any entity that provides financial services involving the acceptance of cash, checks, other monetary instrument, or other stores of value, and the payment of a corresponding sum in cash or other form to a beneficiary. Remittance transfer company or RTC includes remittance agent, remittance platform provider, and e-money issuer, which refers to an entity authorized to provide money transfer or remittance services using electronic stored money value system and similar digital financial services. And then lastly, we have the designated OPS, which may either be a systematically important payment system or SIPS, which is a payment system which poses or has the potential to pose systemic risks that could threaten the stability of the national payment system, or a prominently important payment system or PIPS, which is a payment system which may not trigger or transmit risks but could have a major economic impact or undermine the confidence of the public in the national payment system or in the circulation of money. At present, BSP has designated 3 systematically important payment systems. So depending on your regulatory interpretation, you may say that all OPS are already AML CFT covered person. This means that the blue circle will swap with the green circle in our diagram. Although that interpretation is still pretty much subject to a definitive regulatory pronouncement, which I do hope will be issued soonest, as this will certainly assist all financial players in relation to the requirements of and from OPS. You see, if an entity is an AML CFT covered person, it would mean that they would need to comply with the same AML CFT requirements as traditional financial institutions. And what are these AML CFT requirements? This would include the so-called pillars of an effective AML CFT program, which are having written policies and procedures, providing ongoing and regular AML CFT training, designating an AML compliance officer, implementing a robust and ongoing customer due diligence process, and lastly, assessing the adequacy of the AML CFT program through periodic audit and testing. Having this program in place would dispel the notion that fintech companies are risky companies and prone to AML CFT risks, since they will be regulated and accepted as if they were part of the established order. Let's now focus on AML CFT risks specific to payments. Interestingly, the very functionalities that are considered the advantages of fintech is at times what makes it vulnerable to money laundering and terrorist financing. Like guns or money, fintech is a double-edged sword. So let's go over the functionalities by discussing the 3 most common: interoperability, customer centricity, and availability. Interoperability refers to the basic ability of computerized system to connect and communicate with one another readily, even if they are developed by widely different companies in different industries. Being able to exchange information between applications, databases, and other computer systems is crucial for the modern economy. FinTech has enabled the integration of physical and digital payment methods that consolidate multiple financial accounts using a single interface. This capability empowers businesses with easier transaction methods and reduce overall costs. Next, customer centricity. Customer experience is now becoming one of the most important factors to merchants, and this approach is just going to increase. New products and services must be customer-centric. Customers continue to demand more individualization of their experience and offerings. And these are being addressed most of the time by fintech, not by banks. As said by Jim Marous, one of the most influential people in fintech, it is non-banks that are setting the expectation for the new generation of banking customers. Lastly, availability. Technological advancement has caused transaction processes and system in a variety of industries and sector to become much faster. Traditionally, they would have to head over their respective bank branches, for example. And remember, certain banks were only open until a certain time. There is no such restriction when it comes to a fintech enabled payment system where transaction can be processed anytime and anywhere. With that, let's now look at the other side of the fintech coin and discuss the current AML CFT risks. We shall see the very functionality that we just discussed are also the openings for the AML CFT risk to enter. Gone are days when you have to physically go to a branch or an office of a financial institution to open an account or to do your financial transaction. FinTech has moved this online. And with that, the emergence of AML CFT crime typologies that were fueled by just doing away with the need for a physical face-to-face with the customer and actually holding the ID presented by them. Since fintech products and services are accessed over the internet, money launderers have taken advantage of the anonymity benefits of online transactions by submitting incomplete, misleading, or false information in order to conceal their identities and avoid AML controls. Unregistered SIM cards have also become the scourge of online trade in the Philippines through scams driven by the anonymity of mobile phone numbers. The brewing typologies include hacking, phishing, smishing, or account takeover. We saw a spike in cybercriminal activity during the shift to digital payments and online banking during the pandemic. Based on the data from the Bangko Sentral ng Pilipinas, customer complaints saw a whopping 2,324% increase in hacking and other malware attacks from 2019 to 2020, while phishing and other social engineering schemes increased by 302%. Between 2019 to 2021, Filipinos have lost an estimated 2 billion pesos or roughly around 4 million US dollar to online fraudster. Money muling is also on the rise. Money launderers may use third parties to engage with fintech services on their behalf as a way to introduce illegal funds to the financial system. These so-called money mules may be vulnerable members of society such as the elderly or the disabled or those who have been coerced or incentivized to take part in the illegal activity. Let's now look at speed. The increasing speed of internet connection means that customer can complete transaction in seconds. Money launderer may exploit that speed by transferring large volume of funds into and out of accounts or between different institutions quickly, outpacing the scrutiny of AML tools or authorities. Further, fintech services can be accessed anywhere and can be used to transfer funds between accounts located in different countries. Money launderers may exploit the cross-border border connectivity of fintech services to transfer illegal funds to higher risk jurisdiction with fewer or less stringent AML controls than their accounts of origin. I guess just to recall, in 2016, thieves pulled off one of the biggest bank heists in history without even cracking a safe. The hacking team, known as the Lazarus Group, tried to steal nearly $1 billion from the Bank of Bangladesh by exploiting the SWIFT network. Unlike the Netflix series, they did not have to enter La Casa de Papel. Unsurprisingly, The rise of fintech has also a positive correlation with the increase in the number of suspicious transactions based on e-commerce violation. The data that you're seeing is taken from a report published by the Anti-Money Laundering Council when it conducted a risk assessment on the Philippines' exposure to threats based on submitted STRs from 2013 to 2017. Notice the spike. Guess it would be interesting to see how the numbers would look like when the pandemic is already part of the mix. Finally, we now concentrate on regulatory approaches to fintech. It is worth noting that there is no one legislation that covers all aspects of fintech. Fintech companies providing financial services must comply with the same laws as any firms offering those services. So unfortunately, in fintech, there is no one ring to rule them all. So in the absence of an omnibus regulation, regulators are currently using three approaches to supervise fintechs, which we can simply call ignoring, ducking, or coding. The first option is to leave fintech largely unregulated. In the early days of fintech, regulators in most jurisdictions chose a wait and see approach. Bitcoin, as a catalyst of the fintech ecosystem, started in 2008 with a seminal paper by Satoshi Nakamoto. However, many jurisdictions had their initial statements issued only in 2013, 5 years after. In general, countries or jurisdictions with low fintech exposure can afford to keep the sector unregulated. The second option is to duck type fintech rules into existing regulations. Some fintech models are essentially digital or crypto representation of an instrument, an institution, or a financial infrastructure platform. A straightforward approach to regulating this model is to focus on their economic function, or more specifically to their underlying risks. The same risk, whether digital or not, would need the same regulatory answer. This strategy is often simplified as a duck test that says, if it looks like a duck, swim like a duck, and quacks like a duck, then it probably is a duck. The third option is to code fintech using regulations that are specifically tailored to new functionality made possible through technological innovation. Duck type regulation works as long as fintech operates in the same way as traditional finance. However, with ongoing financial innovation, new combination of risks might emerge or will emerge. While underlying risks would stay the same, it would become clear that using the same rules is insufficient, and a separate additional microprudential layer is necessary. So that begs the question, what is considered the correct regulatory response to fintech? That, my friend, is still an ongoing debate and at times an experiment. Although in regulating fintech, I cannot help but recall the interesting exchange between Alice and the Queen of Hearts in Alice in Wonderland. During the trial of the Knaves of Hearts, who was accused of stealing the Queen's Tart, the exchange goes, the king said, "Let the jury consider their verdict." "No, no," said the queen. "Sentence first, verdict afterwards." "Stuff and nonsense," said Alice loudly. "The idea of having the sentence first." "Hold your tongue," said the queen, turning purple. "I won't," said Alice. Off with her head, the queen shouted at the top of her voice. I pray that both legislators and regulators would not approach fintech as a queen of hearts. It's true. It's true that it's still far from clear how technological developments will disrupt the financial industry, or how far technology might promote competition and diversity as often assume, or whether it might instead foster the emergence of new, potentially global big tech oligopolies that could work against the interests of consumers and generate new kinds of financial stability risks. However, despite the big unknown, one must not forget that although regulation acts as an enabling factor for relevant institutional changes, it should still leave sufficient empty spaces that are used to design innovative solutions. We said earlier that fintech as a term can trace its roots from the Financial Services Technology Consortium, which actually sponsored non competitive collaborative research and development of interbank technical projects affecting the entire financial services industry. Its mission is to help members collaborate on technical and business aspect of technology so that they may rapidly bring innovation in service. So when fintech was conceived, the notion really was collaboration and not disruption, fusion and not division. Finance and technology companies are increasingly forming dynamic partnership to create finance solution which improve the overall customer experience and eliminate inefficiencies. And for that, finance and technology would always be a perfect matching.